So this is the Rchrp, the revised Rchrp 03 for November 2022. We are now at number 4B. Number 4B, which talks about on 1st of January 2021, Rchrp started business with 160,000 shillings cash in hand, and then the following transactions took place during the month. So before we go to the transactions that took place during the month, we need to record that capital. We need to record that capital that was received in the business on 1st of January 2021. From the rules of recording transactions in ledger accounts, anytime a business receives capital from the owner or the owners, the business capital account should be credited. The business capital account should be credited, and then you debit either cash or bank, because when capital is brought into the business, it is either going to be deposited in the business bank account or it is going to be received in the business cash box. In this case, the capital was deposited in the cash box. That is why they say it was 160,000 cash in hand. So we shall debit cash because cash is an asset. Cash will be receiving 160,000. We debit the cash and then we credit our capital account. So just a minute. We credit capital, then we debit the cash. If the amount had been deposited in the bank, we could have debited bank account. So that is what we shall do. Then on 4th, deposited 100,000 cash into the business bank account. That is simply a transfer. Part of the 160,000 that was deposited in cash, they are now being taken to the bank. So because 100,000 will be deducted from the cash that we had in hand, we shall credit cash, because anytime cash flows out, we credit the cash account, then we debit bank. Anytime money is received in the business bank account, we debit the bank account. So we are receiving money in the bank account, we debit bank, money is coming from cash, cash is reducing, you credit the cash account. That is what we shall do. On 8th, bought equipment for 40,000, paying by check. Paying by check simply means that our bank balance will reduce by 40,000. So anytime bank balance is reducing, we credit the bank and then we debit the equipment. Anytime you buy an asset, you debit the asset being bought, then you credit either cash or bank, and if it is on credit, you credit the supplier. The proprietor took 12,000 cash for personal use. Anytime the word personal use is mentioned, just know that those are drawings. Those are drawings. So we shall debit the drawings account, then we credit cash account, because that is cash from the business reducing as a result of the drawings. And lastly, proprietor brought in personal equipment valued at 18,000 for business use. That is the same as the transaction of 1st of January. On 1st of January, the owner brought 160,000 cash into the business, and that was capital. On that year, he has brought personal equipment into the business. Anytime the personal resources of the owner are converted into business resources, that is capital. That is capital. So on 1st, it was personal cash being converted into business cash. That is capital. On that year, we converted the personal equipment into business equipment. That is still capital. We credit capital on that year, we debit the equipment. Credit capital, and then we debit what has been brought into the business. So let us see how those transactions were supposed to be entered in the ledger accounts. So we have the first one is capital. Before you do anything, receive capital. Business cannot operate without capital. So we have the capital account. That capital is in cash form. This is capital, this is an asset account. Anytime capital is introduced into the business, you credit to the capital account. So if you come here and say, 1st of January, that capital is in form of cash, 160,000. So we have received the capital as cash, and then on the same date, cash having been received, you debit. This is an asset. Anytime an asset is received in the business, you debit the asset account. So 1st of January, it is coming in as capital of 160,000. Coming in as capital of 160,000. That is that. We now proceed to January 4th. On January 4th, we deposited 100,000 shillings cash into the business bank account. So you open a bank account, the regular account for the bank. This is another asset account. So cash is transferred from year to year. So these two being assets, one of them will be increasing, and that is the bank balance will be increasing, whereas the cash balance will be reducing. You credit the cash because it is a decrease in asset, you debit the bank because it is an increase in asset. So we say 4th of January, in the bank, we shall debit by cash of 100,000. In the cash, it is a decrease. 4th of January, the money is going to the bank, 100,000 shillings. 100,000 shillings. That. On 22nd, the proprietor took 12,000 cash for personal use. We have agreed anytime the word personal use is mentioned and some resources have been transferred from the business, we take them to an account we call drawings. That is the correct name. So don't make a mistake. Others will normally do a mistake and we call them personal account now, or personal use account. We don't have such account. It is the drawings account. So to the drawings account, it is always debited. Anytime you take cash or withdraw money from the bank, or you take stock items for your own personal use, we debit the drawings. So there is no day we shall credit drawings account. It will always be debited. So we shall come here and say, this is 22nd of January, and this drawings was in form of cash. The amount is 12,000. That tells you that the business cash has reduced because the owner has taken 12,000. So we credit the cash by 12,000. 22nd of January, these are the drawings. 12,000. Lastly, on that year, the proprietor brought in personal equipment, so we shall have to open an account for equipment. And because it is the owner bringing in, it will affect capital. It will affect capital, or the other account that is affected is capital. Anytime the owner brings in something, whether it is cash, whether it is money deposited in the bank, or whether it is a fixed asset that is converted from personal into business asset, we credit capital, we debit the asset that has been brought. In this case, we brought equipment. If he had brought furniture, we could have debited furniture. If he could have converted his personal motor vehicle into a business motor vehicle, we could have debited motor vehicle, but capital account will always be credited. So we shall do this on 30th of January. This was the equipment. Capital in the form of equipment of 18,000. Then the equipment is an asset being received. Anytime the business receives an asset, whether you have bought it or it has been brought by the owner, you debit the asset. Then from there, you do a very simple balancing. You do the balancing of these ledger accounts for you to earn the full 10 marks. You have some marks already, but for you to earn the full marks, you need to have your ledger account balance. So here, we are going to have 178,000 on the credit. How much is missing on the debit to make that account balance? It is the same 178,000. The amount that we put on the other side, which is less, for it to balance with the amount on the side with the higher amount, it is the closing balance, and we call it balance carried down. At the end of every period, the balancing figure, we call it the balance carried down. And it is normally captured using the last date of that month. So we can say on 31st of January, our balance carried down is 178,000. By doing so, this side will also have 178,000. So we are putting this figure so that the figure on this side and the total on the other side will agree, so that that account can be balanced. The totals, have them in the same horizontal line. Have them on the same horizontal line. This balance that we have closed with in the month of January, it is the balance that we shall open the next month with. We shall start the month of February with that balance. So the first day of February, we call it a balance breakdown. 178. So we start with the carried down with the last date of the month, and it is the difference between the side with more and the side with less. In this case, this side was having 0, this side was having 178,000, so we need to put 178,000 here for the two sides to balance. This is the carried down at the end, the brought down when we start a new month. What about cash? We received 160,000, we have spent 112,000. We received 160,000, we have spent, or we have transferred or spent 112,000. So in the cash account, our balance carried down, the closing balance, it is 160,000 minus 112,000, which is 48,000. So we are putting this 48,000 so the two sides can agree. So we shall have there 160,000, and this side will also have 160,000. This balance, it is a debit balance. Why? Because it is the debit that was having more than the credit. The credit was having 112. The debit was having 160. So it is the debit with more. So when you start the new period, the balance brought down will be on the debit, which is the same amount as the carried down. The carried down is the same amount that becomes the brought down. In this case, the carried down is here because it is the credit with more. So
Yes, Marim.
Yes.
We recorded the transaction on date 8.
We skipped that.
I think so. We bought equipment of 40,000 by check.
We skipped that transaction.
Okay.
That we can incorporate it here. So here, that means that we skip it is an error of complete omission. 30th of, it was 30th of what? 30th of January. Capital. It was 18,000. So on 8th of January, there is an equipment that was brought, or was bought actually, by check. So it will affect the bank. It was 40,000. Correct? And then to the bank, it is money spent, you credit. This is the money out to finance the equipment. So you write here 8th of January, money was spent on equipment, 40,000. Okay. That is good, Derek. Yeah. We have omitted that. But it it was an equipment board. We are supposed to debit equipment. We credit bank. Anytime you spend money, you credit cash or bank. So I was explaining on these balances. The carried down is captured on the side with less, but the brought down is taken back to the side that had more. This was having less 178,000, so we had to put it here for the balancing to occur. But now the balance belongs to the credit because that was the side that was having 178,000 more than the debit. In this case, the balance carried down is here because the credit is having less, 48,000, so that we can have 160,000, 160,000. Because the carried down is on the credit, and if it was the side with less, then when we start the new period, the balance brought down will be taken back to the side that had more. So it is the debit that was more than the credit by 48,000. It becomes less of the balance. For the bank account, you can see that we had received 100,000. We have spent 40,000 to buy the equipment. So the balance carried down is going to be 60,000. So that we have 100,000 here. We also have 100,000 here. That has balance. But now, when we start the new period, where will be the balance? This side was having more than the credit by 60,000. So the balance belongs here. 1st of February, the balance goes down of 60,000 will be the debit. The drawings, this side is having 12,000 more than the credit. So on that part, the closing balance is 12,000 on the credit, so that we can have 12,000 and 12,000 there. This balance is the debit because the debit will be more. 1st of February, the balance goes down will be on this side that had more. Equipment, we have equipment valued at 58,000. So on that 1st of January, the balance carried down is 58,000. So that here we can have what? 58,000. This balance belongs to the debit because it's the debit that had 58,000 more than the credit. So 1st of February, the balance goes down is 58,000 on the credit. That's all. That's all that question. So just revise on the edges. Very simple. When you are alone to do it, it will take you very short period of time if you have done good practice. Okay, let's see the next question. The next question talks about the following information relates to China traders for the year ended that. I think I've skipped something. We are supposed to go to question number 5. It is all about the ratios. The ratios, whereby we are told that the following information was extracted from the books of Zabaleta and Zionita traders for the year ending 31st December 2021. When it comes to the ratios, it is just a matter of remembering the formulas for each ratio. Just remember the formulas for each ratio. Once you have the formulas for each ratio, you get the figures from the balances that you are provided, and then you compute the ratios. So in this case, we are told we need to compute the rate of stock turnover for Zabaleta and Zionita separately, and the current ratio. So it is a matter of recalling the formulas. A matter of recalling the formulas. So when it comes to the rate of stock turnover, we normally get it by the cost of sales divided by average stock. The cost of sales is divided by the average stock. But if you look at the question, they have not given us a figure for the cost of sales. So they just require you, or they are testing you whether you remember how to compute the cost of sales. When we are preparing the income statement, we have insisted severally that the cost of sales on the COS is given by the opening stock plus the purchases minus the closing stock. How simple as that? The opening stock plus the net purchases. Opening stock plus the net purchases gives you the cost of goods available for sale. Then you minus the closing stock, you get the cost of sales. And we are given those figures here. We are given the opening stock, we are given the closing stock, and we are given the purchases. So you can simply get the cost of sales comfortably. When it comes to the average stock, you need to use the opening stock plus the closing stock, you divide by 2. Just that. Once you remember that, you can comfortably calculate those ratios for your Rchrp and your NICA. So you can do them in form of a table. So for the COS, cost of sales, we come here and do the opening stock for the Rchrp is 400,000 plus the purchases, which is 750,000 minus, don't think whether this space will be enough. We just calculate them one by one instead of a table for the Rchrp. It is going to give opening stock, which is 400,000, plus the purchases of 750,000, minus the closing stock of 600,000. That gives you the cost of sales. Then you divide by the average stock, which will be given by opening stock 400,000, plus the closing stock 600,000. These figures you divide by 2. In the bracket, you divide by 2. So what will you get? $400,000 plus 750,000 minus 600,000. You get 550,000. You divide by the average stock. This is 1 million. 400,000 plus 600,000 is 1 million divided by 2. It is going to give you 500,000. So this one gives you an answer of 1.1. And when it is turnover ratios, we normally record in number of times. So it is the number of times you are replacing your inventory, or the number of times you are converting your inventory into sales in a period. So it is 1.1 times. This is 550,000. I can see there is a reflection there. 50 divided by 500. For Zioneta, you take the opening stock for Zioneta. You take the opening stock for Zioneta. Get the opening stock for Zioneta, which is how much? 600,000. Add to purchases, 1 million. Then you subtract the closing stock, 400,000. That will give you the cost of sales. Opening stock plus purchases minus closing stock is the cost of sales. Then you divide by the average inventory, which is the opening stock for Zioneta, 600,000, plus the closing stock for Zioneta, which is 400,000. These two we need to divide by 2 to get the average inventory. So that is going to be what? If you do this, it's going to be 1,200,000. We divide by this is another 1 million divided by 2, 500,000. You get what? You get a figure of 2.4. 2.4 times. The rate at which you are converting your stock into sales, or the rate at which you are replacing your inventory. So this business is doing better than this. This business is making more sales. The number of times you are replenishing your stock, if it is high, it simply means that your sales are high. Good. Then the second one, the second ratio, it is about the current ratio. This was the rate of stock turnover. Number 2, it is about the current ratio. Which is given by the totals of the current assets. You divide by the totals of the current liabilities. Totals of the current assets divided by the totals of the current liabilities. By now, I understand, or I hope, and I wish you know which are the current assets in a business. And also know which are the current liabilities in a business. The short-term assets, those assets that will not be in the business for long. They include the cash, the inventory, the debtors, the cash at bank. Those are the current assets. Even the prepaid income, so prepaid expenses and accrued income. For the current liabilities, these are the business debts that are payable within a short period of time. The creditors, that is the amount of money we owe the suppliers. The bank overdraft, the accrued expenses not yet paid, and the prepaid income, the income that we receive in excess, which we are supposed to refund. Those are the current liabilities. So you need to go now to the figures and identify the current assets, you add them, and also identify the current liabilities, you add them, and then the totals of the current assets, you divide with the totals of the current liabilities. And that's all. And that's all. Or this was rate of stock turnover. Rate of stock turnover. Number A. Number B is the current ratio for Zabareta. Because what? You take all the current assets, and remember here now we shall use the closing because it is for the year ending at 1st December 2021. The asset here between the opening stock and the closing stock is the closing stock. Because we are talking about as at that 1st December, what do you have in the business as current assets? In terms of inventory, what we still have is the closing inventory. The inventory that had not been sold in that year, that is the asset, not the opening. The opening was the unsold stock for last period, so we started with those inventories this year. So by the end of the year, what is not yet sold, it is still an asset to the business because it is a resource still owned by the business, the closing inventory. 700,000. This is money not yet received from the customers, that is the debtors. The bank of 300,000. Those are the only current assets. Don't mix things. Sales, purchases, those are not assets. Then we divide by the current liabilities. In this case, it is only the creditors. The balance that we have not settled with our suppliers, which is how much the creditors is. So if you do the total, this is going to be 1.6 million for the current assets divided by 200,000. Give you what? You get 8. This is the ratio. Current ratio, quick ratio, or acid test ratio. The answer you get, you put in ratio form is to 1. You introduce is to 1. So the ratio is 8 is to 1. For 8 units of current assets, we have got 1 unit of current liability. That is what we need in this. 8 units of current assets versus 1 unit of current liability. And this is a bit too high. Yes? The recommended current ratio is normally 2 is to 1. This simply means that this business has got a lot of idle current assets, or a lot of idle cash to be specific, which can be converted into investments and earn other incomes. So this is a bit high. The recommended is supposed to be 2 is to 1. For every 2 current assets, it is supposed to support 1 liability. This is a bit too high. We have got a lot of idle resources. For Zionita, you do the same. You take all the current assets that belongs to Zionita traders. The closing stock is 400,000. You add to the debtors, which is 800,000. You add to the bank balance, which is 500,000. Then divide what? You divide with the current liability, which are creditors, 400,000. If you add the numerators, this is 1.2, 1.7. You divide by 400,000. Divided by 400,000. $4.25. You put them in ratio is to 1. Current ratio, quick ratio, acid test ratio, those are the liquidity ratios. We normally put them in 4.25 of the current assets is support 1. It is still a bit high. It's still a bit high. So that is what was required. So it was testing you to know how do you compute the cost of sales. You know the current assets, you know the current liabilities, and the others. So they did not give you those figures straight. They wanted you to get them from the balances given. Good. Question 5B, it's about Delta Limited. A manufacturing company uses a certain material in the manufacture of its product. The following information relates to the material for the month of August 2022. We are given the transactions, and then we are told to prepare a stores revenue account using last in, first out. That is the RIFO method. 5 marks. 5 marks. Those transactions are very few, so it is very easy and very fast to do that question. So the storage account, I've always insisted anytime you are told to prepare something, the starting point is for you to prepare in the right format. In the right format. That is where the marks will start being awarded from. So we say a storage account, this is the recommended. And we are preparing the stores for the account. We have the column for the date. We have the column for the date. And 6. The issues and the balance. Whereby you say this thing, you need to have a column for the quantity, the price, value. Quantity, price, value. The same here, quantity, price, and value. Whether it is T4, T4, weighted average or simple average, the storage account will have those columns. We have those columns. So last in, first out simply means what we receive latest. Whatever we receive latest, it is the first one to be issued out, either to the production or to be sold. What we receive latest, the last bin to be received or the last consignment to be received should be the first one to be issued out. So if we read from the statement, it says that the Delta Limited, a manufacturing company, uses a certain material in the manufacturing product. The following information relates to the material for the month of August 2022. August 1, the farm had 150 units, of materials which had been bought at 50 shillings per unit. It is a balance. The farm had, so it is a balance. It is the opening balance in short. So first of August, this is the opening balance. It is not something that we have bought. If we had bought, we could have started it here as received, but it was already in the books. So you capture here as what? They were 150 units. They had been acquired at 50 shillings. So if you multiply the two, they give you the value of that balance. 150 times 50 gives you 7,500. That gives you 7,500. That is the value of the opening inventory for that item. So don't capture it as a receipt when it is a balance. It is the opening balance, just to fit to the balance. Great. Then on 2nd of August, we bought, that is now a point of receipt. We received 330 units. At what price? At 55. You take the 30 times 55, you get 8150 is the value. 8150 is the value. So what do? You take them to the balance. The moment you receive them, you transfer them to the balance. But to the balance, we first of all capture what was already there. 150 at 50, that is 7,500. We have received 330 at 55, that is 18,150. For people and people, we say we don't combine them. We record every consignment separately under the balance column. We don't combine them. That is on the 2nd of August. we received. So we received this. Once you have received them, you go and record the balance after that. The consignment for LIFO and FIFO in the balance don't mix here. The simple average and the weighted average, we use to add the units, we add the values, but here we don't do that. We record them separately. On that, we issued 160. This is now where LIFO applies. This 160 that we are issuing, if it is under LIFO, you need to ask yourself, between these two consignments, which is the latest to be received, which is the one that was received recently. Obviously, if it is this consignment of the battery, that is what has been received recently. So this 160 units that we are issuing will be issued from this consignment at this price. So you just write here, the 160 units will be issued from this that were acquired at 55. We use the price of the units that we have issued. We have issued this to 30, they were both at 55, so we issue them at 55. So it is going to be 160 times 55, giving you 8,800. After doing that issue, what will be the balance? The balance will be 150 units of each, 7,500. For this one, we have subtracted 160 and issued. So 330 minus 160 that were issued, it simply means that this consignment has 17 units left at 55. You get 98. That is done. On 4th of August, we issued another 50 units. They will still be issued from this one. That consignment has not been exhausted. So we issue from this one, whose price is 55. You get 2750. The balance will be 150 at 50, 7,500. After issuing another 50, now we can have a balance of 120 at 55. You get 6,600. After that, the next date is 5th of August, where we received for 20. We received for 20 at 60. $25,200. When you take them to the balance, every consignment capture it separately. We have got 150 units that were acquired at 15, 7,500. 120 units acquired at 55, 6,600. And now we have a new consignment of 420 units acquired at 60 with a value of 25,200. If you are now asked to compute the value of the closing inventory using the LIFO method, the closing inventory is the sum of what we have in the last cell to the right hand side. So the closing stock value is 7,500 plus 6,600 plus 25,200. The value of the closing inventory. The balance at the end of that date. So you get what plus 500 plus 6,600. You get 39,600. That is all. That is all about LIFO. LIFO you issue. The only point they differ with the FIFO is the way units are issued. Under LIFO, we start from the latest going upwards. But if it was FIFO, we could have started from the ones that were received first That is 150. We could have issued this 160 from 150 first, and then add 10 from here. We could have issued 150 first, and then because we need 160, then we reduce from this. So that is how we could have done. But if it is now reform from the most recent going backwards, the one that was received earliest. If you have a question, you raise it anytime. You raise it anytime. So there's this question. It's actually question what? Question 5B. Okay. Question 5B, yes. It is about the statement. So you are given the balances. Then you are told to prepare an income statement for the year ended 31st of December 2021. So it is a matter of organizing these figures. We are given the additional information. Anytime you are given additional information, those are the end year adjustments that we say. So in this question, we are given the closing balances in terms of what? When the insurance is due, it simply means it is outstanding or it is accrued. We add to the insurance amount that is in the balance. Writing paid in advance, we subtract because we overpaid. The same case to salaries. So in this question, it is an easy one because we are starting from the gross profit. We are starting from the gross profit. So it's about China traders. We need to prepare its income statement. Just understanding the flow or preparing those statements. And I've said, and I will say again, these are the questions that we never miss in the exam. The financial statements we never miss in the exams. Know how to arrange those items and also understand what goes to the income statement, what goes to the statement of financial position. Income statement, we deal with income. How do we generate income? The sales, the cost of sales, that is the opening stock, closing stock, and the purchases. Other sources of income, then we deduct all the expenses, we get our performance in terms of profit or loss. But for the statement of financial position, just dealing with assets, capital, and liability. Whatever we have or what we normally have in the accounting equation. So in this case, it is about some kind of traders. Some kind of traders. Income statement. For the year ended. When did the year come to an end? 31st of December 2021. That is when the year came to an end. So, whenever we are not dealing with an adjustment in purchases, we only need 2 columns for amounts. We only need 2 columns for amounts. So, we normally start with the gross profit. If it was sales, we would have started from the top, but here we are starting from the gross profit. The gross profit for the year, it is 950,000. Then after writing the gross profit, please confirm whether we have got other sources of income to this business. We have discount received, we have rent received, we have commission received, interest received, decrease in allowance for doubtful debts. So you find out what do we have. If I read through the question, I can see we have got commission income, so we add it there. The commission income, it is of 16,000. If I go through, I can also see discount receipt. They are added to the gross profit, 20,000. So if you add the gross profit from plus other incomes, you now get the total income. Plus, I'm getting 96,000. This is my total income. Then I come here and rest expenses. For the expenses and also these incomes, you need to be a bit keen to find out if there is any adjustments that are required. So let us start with the additional information so that we can get those expenses with the correct figures. So we have depreciation. Depreciation are expenses. One is depreciation on what? Equipment. With the depreciation on equipment, we are told it is 10% on cost. So we do 10% times the cost of the equipment, which is 50,000. If you do that, you get 85,000 as the depreciation for equipment. For motor vehicle, we are told it is 25% of the cost. The cost of the motor vehicle is 1,200,000, which will be equal to 300,000. 5% of 1.2. Then we are told about furniture, which is 5% times the cost of the furniture, which is 500,000, which is equal to 35,000. 5% of 500,000, 25,000. We are dealing with additional information number one. So that is what we are shown so that we can be able to calculate the depreciation expenses. Then Roman 2, insurance requires adjustment and it is due. Due means that we have not paid. And that amount, it is not included to what we have as insurance. Remember, insurance, we are given a figure of 56,000. Then there is 6,000 that is yet to be paid. It is due. So how much insurance were we supposed to pay? It is what we paid plus what we have not paid. It will give us the total insurance expense for that year that ended at 1st of December 2021. When it is outstanding, accrued due, you add what was paid. So we were supposed to pay 62,000. The other one is about writing. The amount paid from the balances up there is 48,000. But here we are told we prepaid or paid in advance, meaning that we paid excess of 12,000. So you minus the 12,000, which is excess, what you are supposed to pay is 36,000. For advance, you minus. For accrued, you add. Then salaries, we were also paid in advance. The figure for salaries is 1,444,000. You minus the repayment of how much? 26,000. So how much were we supposed to pay? $1,418,000. That is what we are supposed to pay towards the salary. If we minus the excess that we paid to some of the employees, then we are done with the additional information. Confirm whether we have got other expenses apart from what we have here. There is discount allowed. Discount allowed is an expense, and its figure is 12,000. You add them, you get the total expenses. is equal to 1,908,000. So the income is less than the expenses. So this business incurred a net loss. $952,000. The net loss of $952,000. So always remember that what is an expense. So I don't expect you to write the cost of the furniture, equipment, and the motor vehicle here. What is an expense is their depreciation, but their cost is not an expense. Their cost is not an expense. Only their depreciation. For fixed assets, we take the depreciation to be the expense. But the equipment or the asset itself will be used in preparing the statement of financial position. Good. So we can move to the next question. Sorry. So the next question is about what? The next question, number 6, which is the last question. Explain 5 ways in which NPV, the net present value, fulfills the requirements of the good investment evaluation. So the characteristics of a good investment appraisal technique, they are number 1, they should consider time value of money. Actually, NPV, that is one characteristic. It considers the time value of money. It considers the time value of money. That is why we normally discount the cash flows. That is why we normally discount the cash flows. Number 2 characteristics is that it considers all the cash flows. It considers all the cash flows. When we are computing the NPV, any amount that is provided in the question, it is going to be part of computing the solution. We are going to involve every amount. Number 3 characteristic, it is that it has a rejection and acceptance criteria. It has acceptance and rejection criteria. If NPV is positive, we accept it. If NPV is negative, we reject the project. So it has a very clear way of accepting or rejecting. The other characteristic is that it uses the cash flows of the profit. It uses the cash flows and not the profit. It uses the cash flows and not the profit. And also it aligns itself with the shareholders' wealth maximization. It aligns itself with the shareholders' wealth maximization principle, whereby a project with a higher NPV is preferred than a project with a lower NPV, so that we can maximize the shareholders' wealth. That is it. And then question number 6B. For those who are on the RMS, if you go to the document that is there, the PDF, under the topic time value of money, all those advantages and disadvantages for each and every investment appraisal technique, they are there. They are there. You can comfortably get them, and it can assist you in answering these kind of questions. When Wema Transporters Limited purchased the following motor vehicles. The firm depreciates its motor vehicle at 20% per annum on costs for each of the years ended at 1st December 2020 and 2021. Prepare the sorry for that. So question, I think now it's okay. I think now it's okay. I think now it's okay. It has stabilized. Huh? So that question number 6B about Wema Transporters, we have two motor vehicles that were acquired. One was acquired on 1st January 2020, the other one was acquired on 1st July 2021. So we are told we prepare the motor vehicle account. The motor vehicle account. How do we prepare the motor vehicle account? The first motor vehicle was bought on 1st of January 2020. So we can say here 2020 because the question says we prepare for each year ended at 1st of December. So we start with 2020. 1st of January, we bought. We normally debit the assets. We assume that we were both using the money in the bank. The first motor vehicle, the KV wagon, was bought at a cost of 600,000. That year, nothing else happened. Nothing else happened. So this is 1st of January. 1st of January, right there at the bank, we acquired a motor vehicle. But this is not double entry. This is just we are going to do the motor vehicle account only. Then, when that year comes to an end, that is on that 1st of December, the balance carried down is 600,000. So that now it can balance at 600,000. And beside the balance we got 600,000. What you close with is what you open with in the year 2021. 1st of in that next year, which is now 2021, there is another motor vehicle that was bought on 1st of July. 1st of July, another motor vehicle worth 1.8 M was acquired, meaning that the total motor vehicle that we ended up that second year, it was costing 2,400. That is what we started here as 31st of December 2021 as balance carried out. That is how your motor vehicle accounting looks like. For every year you balance. This is what happened in 2020. We only acquired this one. Then at the end of that year, we only had that motor vehicle that cost to balance it. The closing balance is the opening balance. So the opening balance plus now the additional motor vehicle that we bought. By the end of the year 2021, we had 2 motor vehicles. The first one was bought at 600 in 2020, and it is our opening balance. Then in July, we added another one. So the two combined, we have got motor vehicles that have posted this, and that is your motor vehicle account. Then we calculate depreciation. So the depreciation for the first one, which is captured as KB wagon, was bought at 600,000. Remember, we are told that depreciation is on what? Is on cost. Depreciation. The farm depreciates its motor vehicle at 20% per annum on cost. So in the year 2020, this KB wagon, depreciation is 20% times 600,000. This is 150,000. In the year 2021, its depreciation still remains 20% times what? 600,000. 120,000. When depreciation is on cost, it is under straight line method. So the depreciation is normally constant. And this motor vehicle, KB wagon, was acquired on 1st of January 2020. So it was used the whole of the year 2020. Then the year 2021, it was also used the whole of that year. So the depreciation is 120, 150. For the other motor vehicle, which is captured as KF Toyota, its depreciation for 2020 is 20 nothing, because it was not there. It was not there. It had not been acquired in 2020. In the year 2021, its depreciation will be 20% times its cost 1,800,000. But remember, look at the date it was acquired. It was acquired on 1st of July. 1st of July, meaning that it was only used from July to December. It was only used for half a year. So you multiply by half. 20% of 1.8 is the depreciation for the whole year. But this asset was not used the whole year. You multiply by the proportion of the time period it was used. It was used half of the year, which is now 6 months out of 12 months in a year. So that is how you do it before you put them into their account. So 0.2 times once you have those figures, you can now do your provision for depreciation account very easily, very fast. Provisions are normally credited, so we are supposed to do provision for depreciation. On motor vehicles account. That is the CR, this is the CR. How do you do it? you credit. You start with the year 2020. Depreciation is calculated at the end of the year, 31st of December. Right here, that depreciation will make it to the profit and loss. It is taken to the profit and loss account as an expense. So in the year 2020, we only had this. We only had this depreciation, 120,000. Then the balance. That year, that part of December, the balance carried down is 120,000. The closing balance here, it is the opening balance when we get to 2021. So 1st of January, our balance brought down will be this 120,000 that we close there again. Then in this 2021, as at the 1st of December, how much are we going to get to the profit and loss as depreciation expense? 2021, we have 120 here. For 2021, and we also have this one for 2021, 180. So 180 added to this, it is going to be a total of 300,000. So that year we are going to take to the P&L 300,000, which is our total of 40,000. So 2021, this is the 1st of December, the balance carried down. So you need to know how much was the depreciation for each year. For 2020, we only had KD in our possession, so we can get the depreciation for that. It was a full year depreciation simply because KD was acquired 1st of January. So it was there from 1st of January to the 31st of December, the whole year. 2021, KD wagon was still there from January to December to calculate, and the if it is on cost, the depreciation is constant. But for KF Toyota, it was acquired on 1st of July 2021. In 2020, it was not there, so not depreciation because the asset was not in use. 2021, now the depreciation is going to be 20% of that. But now you consider the element of the proportion of the year it was used. It was used for part of the year. So when you bring here the figure to be taken to the P&L for the year 2021, it is going to be the sum of this and this. And you are done. You are done. So I want you to now go and try the last question. Question number 6B. Question 6B is just theoretical.